The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
This is Don Creech.
And this is Perry Sykes, and welcome to the Investor Resources Podcast. We're going to talk a little bit this morning right off the top about asset allocation. Asset allocation is supposed to be more or less a dial that you can use to adjust the risk and the expected return in your portfolio up or down. Yeah, you can add more stocks and it increases the risk, but it also increases the returns. And you can add more bonds and the returns go down, but so does the risk. And that's what they want you to believe is happening, but all that really happens is that it's changing what's in your portfolio. There's really no consistent outcome to those changes. You really can't just dial it up and down. And anybody who expects any more than that, anybody who expects any sort of asset allocation magic, such as getting additional return without the risk, or reducing the risk without reducing the return, just from a different asset allocation mix, is likely to be very disappointed. So this morning we're gonna back test some of these and see what they actually look like if you'd changed your asset allocations over time, and really show you exactly what we mean here. And this is going to be our base case. This is going to be where we're going to start, the classic 60-40 stocks to bonds portfolio. This is 40% U.S. stocks, 20% international, and 40% bonds. So it's a mix of U.S. and international on the equity side, 100% U.S. bonds on the fixed income side. So this is just your basic straight ahead 3-fund asset allocation model that's very moderate and used extensively throughout the investment world. So let's take a look at some of these if we made some changes. So here's what happens if we substitute 20% of the U.S. market allocation with REITs, with real estate for 20%. So now it's 20% U.S. stocks, 20% international stocks, 20% REITs, and still the 40% of the total U.S. bond market. This begins back in 1994. That's the earliest date that we had for the REIT data. But when you look at those two lines, this is the standard 3-fund portfolio we started with. The red line is when we drop 20% of the U.S. Equities and add real estate. They're really very similar. They're not the same, but man, they are really, really close. And really, that shouldn't be too surprising, because we more or less replaced stocks with stocks. We took a mixed U.S. equities broad market, and we put in real estate, which is just another portion of the equity market when you're buying REITs. So the performance is just very, very similar. So right off the bat, you can see there was really no magic there in making that switch. There was no big change in the portfolio. So what if we use small cap value? A lot of small caps been beat up lately, and many people anyway are saying, well, now it's gonna change. Small cap's gonna snap back. And here's what happens if we substitute half of the U.S. position, again 20%, with small cap value. And then we're also going to move 1% from both of those stock categories into the bond fund to adjust for the fact that the small caps are slightly riskier. So we're going to own a little bit more bonds. So now the portfolio is 19% U.S. stocks, 20% international stocks, 19% small cap value stocks, and 42% bond market. And this goes back to 87, begins in 87, comes up to September of 2023. And again, very, very similar. If either one of these portfolios was appropriate for you, the other one would be too. They're not different enough that it's like you should not own this. So if you went from a broad market to really quite heavily focused on small cap, you get almost no change over an extended period of time. You've essentially got the same returns. There is no magic in that allocation switch. So what if we look on the fixed income side? What if we start changing the bonds? And this chart, we use an intermediate treasury instead of the total US bond market. And because treasuries are safer than the total bond fund, we're adjusting the stock allocation back up that 2%. Again, again, this begins back in 1987. And again, nothing magical here. They're very, very close to being the same. And that's a substantial change. We had a huge change in just buying the total bond market instead of just intermediate treasuries only. So the least risk possible. Not much in the way of change here. It's pretty much the same. They are so similar. Again, a substantial change in the asset allocation, but almost nothing in the outcome. Everything is pretty much just the same. One more comparison. This time we're going to use short-term treasuries and go back and the small cap value switch. Again, same thing. So we're changing both the equities and the bonds together, trying to get some sort of reaction out of the outcome. But over a long period of time, boy, they're virtually identical. Again, if one of these funds was appropriate for you, one of these models, the other one would be also. There's nothing here that's going to say, well, that disqualifies me, now I can't do it. So it really doesn't matter when you're tinkering around with the asset allocation, even changing 20%, swapping 20% out, one for another. I really can't get too excited about the difference between any of those lines on any of these charts. They're all about the same. And that's just a few of the things that we're looking at. This is not hard to do. You can do this yourself online. There's plenty of places where you can look at historical returns for different time periods. And if you do that over different periods, of course, sometimes one will look a little better than the other. But over time periods like this, there just are no significant differences. There's no magic in that asset allocation decision that's being made. There's nothing in that asset mix that's going to drastically change the risk or the return of your portfolio. And that's the important part. It's not to say the asset allocation doesn't matter, but at least in our opinion, it's probably not worth spending a tremendous amount of time on trying to figure out what exactly your asset mix should be. There's not one asset mix. You need to know your goal, and once you know where you're trying to go, there's plenty of different ways to get there. We usually vote for whatever is the simplest. We don't want to get too complicated. But we would definitely encourage you not to look at asset allocation as having some magical mix of assets that are going to really bring you to your goal. It's not going to happen that way, even though that's the way it's advertised. That is exactly what Wall Street's going to tell you is going to happen. And let's look at what they really are selling and what they really think that the magic is. This is the efficient frontier. This is over 80 years of a 60-40 portfolio, and this is what they're really selling. This efficient frontier, which says on this chart, we have the return on the vertical and the volatility on the horizontal axis here, and they're saying that over here on the low volatility side, we're going to have all treasuries, no stocks. We're going to have the lowest return and the lowest volatility. And out here, 100% stocks, we're going to have the highest return and the highest volatility. And it makes it look very, very orderly. You can easily change the amount of stocks in your portfolio and increase or decrease the return, and correspondingly increase or decrease the volatility in your portfolio. That's what they're selling. But this long time frame, this north of 80-year time frame, that's what's hiding the volatility that's in this. It just looks smooth because of the super long time frame. Let's take a look. If we just break that same data, let's just break it down decade by decade and take a look at it. And of course, it's very, very different. The returns are all over the place, but the ones that we really want to point out to you are back in the 1930s, this orange line, where the more risk you took, your return kept going down. Let me say that again. The more risk you took, your return kept going down. Same way here in the 70s. This line is leaning the wrong direction. More risk, less return. And of course, in the 2000s, after the tech bubble busted, same thing. The most dramatic one, the more risk you took, the lower your return got over time. So, and these are 10-year graphs, okay? So these are 10 years. So over 80 years, 30 years of that time, this process was working backwards. 30 years of that time, the more risk you took, the more stocks you owned, the less return you got. There were plenty of years where it worked fine, but 30 years where it worked backwards. It worked against you. That's the problem. At that point, it disqualifies it from use for us, that over long periods of time, decades at a time, this process works backwards. It's working against you. You're trying to catch up from losses that you've incurred, so you take more risk, and when you do, you actually lower your returns. So the process not only doesn't work, it actively works against you. And that's what we want to avoid in our process. And here's what we use instead. We looked at diversification and found out that how your portfolio is doing has nothing to do with that asset allocation mix. It does have everything to do with the relative strength of what's in your portfolio compared to other investments with things that could be in your portfolio. And the relativity is based exclusively on the price and the momentum of an investment. That's where we came up with our RPM our RPM formula. Returns equal the price and the momentum. That's our RPM system. You see that on every slide. Returns equal price and momentum. It is not driven by the asset allocation mix. Your returns are driven by the price, what you pay for it, whatever is in your portfolio, and the momentum. Where is it going? Is it going up or down, and how fast is that moving? It's got nothing to do with a fixed asset mix, especially based on historical returns. It makes no difference what's happened in the past. What's happening right now, and things right now are more different than they've ever been. So the returns that you're looking for, you don't want to get stuck looking at that asset allocation mix and thinking that that's going to bail you out. It's not. It's not going to help. You have to be more in tune with what's going on in the market right now and making changes. And the best way that we could determine to make those changes is to have a system. And it needs to be systematic. It needs to be rules-based. We don't really want to make anything that we do with a client portfolio based on our opinion about what's going on. We want rules that are going to tell us, in this situation, here's what you're going to do. And we've developed those. So to build a portfolio, first we define the inventory. We look at what can get into our portfolio. And for us, it's exchange-traded funds. We manage exclusively with exchange-traded funds. We don't use any individual stocks because of individual company risk. The fund takes that off the table. We are going to have a look at a broad range of things, so we're never going to own a single pharmaceutical company. We're never going to just buy Pfizer. We'll buy a fund that has 400 pharmaceutical companies, and it spreads that risk out right away. We're then going to determine, of those funds that are available, which ones make it into our portfolio. In general, you've got to be in the top 20% to even get looked at. So the first thing we do is we cut off the bottom 80% of all funds that could be in our portfolio as not being strong enough. We're looking at that relative strength. We want the ones that are strong. We want the ones that are at the top. And so we continually look at the price changes and see where the returns are. And then we just continuously look at that portfolio and see what we need to do to change it. Do we need to change what's in there or not? And are we still doing okay or not? And even if a fund's doing well, are there other things that are doing better? That's how you continue to rotate into the strength of the market and away from the weakness. So it's a continual process, and we never have a set portfolio. We're never done and saying, well, that's it. This is where we're going to stay. It's just not. It just doesn't work that way, and it's never going to for our portfolios. You have to be able to be adapting to current market conditions. That's the only thing that can keep you near the right place at the right time. So always remember, there's no simple magic in asset allocation. The answer to where you find where you should be invested is the data. It's always the data. That's where the real information comes from. Listen to the market. Let it tell you where your investment dollars need to be heading. It's just a losing game to try and tell the market where the gains are going to be made. Here's what's happened for the last 50 years, so I'm going to do that for the next 50 years. That's telling the market, here's where I think the return should come from. And as we say so often, the market doesn't care. Every day, things happen in the market that have never happened before, and you need a process that's adaptable enough to make those changes as the market unfolds. It's also got to be disciplined enough to continue to reevaluate what's going on out there. And then when those changes come up, you have to have enough confidence in your system to make the changes. You have to be able to say, this needs to be adjusted right now, and we're going to do it. It's being able to actually make the change with some confidence that will make it work for you. And that's what you need to keep in place. You have to have that process. We've got it, and we think it'll work for you.